Most high yield ETF portfolios look incredible until you project them out 20 or 30 years. Because the real challenge isn't generating income today, it's creating a portfolio that can survive, continue compounding, and still grow long term while paying meaningful cash flow. I built a 5 fund portfolio using DEVO, QDVO, IDVO, QDPL, and QSIX. And when I projected the numbers 30 years into the future, the results were very different from the ultra high yield portfolios I usually test. Because this portfolio isn't built around maximum yield, it's built around something much more important: sustainable income growth and long term compounding. And honestly, this may be one of the most balanced portfolios I've analyzed yet. Let's dive into the numbers. Welcome back to Simply Money. Today we're looking at a very different type of income portfolio because instead of chasing 20%, 30%, or even 50% yields, this portfolio focuses on something that many investors overlook: balancing income with long term portfolio growth. The 5 ETFs we're using today are DEVO, QDVO, IDVO, QDPL, and QSIX. And what makes this portfolio interesting is it combines dividend growth, tactical covered calls, growth exposure, momentum, and international diversification. So today we're forecasting portfolio growth, income generation, and reinvestment impact, and what this strategy could realistically look like over the next 30 years. Because sometimes the portfolio with the highest yields don't produce the best long term outcomes. And this portfolio may prove exactly that. But before we get started, remember this is not financial advice. This is for informational and educational purposes only. I'm not a financial advisor. Please do your own due diligence and know that all investing comes with risk. I'm not telling you to buy these funds, not to buy these funds. I'm just sharing with you what the data shows, and we're using past data to forecast future outcomes, which we don't know if that will sustain. So please remember that. Now, here's the worksheet we're going to be looking at for those that are new and never seen this. This is our Simply Money Portfolio Planner. If you like this, you can get a copy down below at Buy Me a Coffee. There's a link in the description below. We have this set up to where you can choose the funds you want to look at, and we have them listed here. If you don't see a fund that you want, if you buy the sheet, just email me and I will add those. Today, we have our tickers that we're looking at over here on the left, and we have it set up. We're going to just look first here at the conservative model where we put an equal amount into each one of those. And you can see the yield here is pretty conservative for what we look at often, the highest being QDVO at 10%. Then you have DEVO here at 5 and IDVO at 7. Again, QDPL at 4.8 and then QSIX at 3.6. So not huge dividend yielders compared to what we look at with like Chippy and Alti and some of those funds. These are much more conservative, QDVO being your most aggressive. We're going to look at a $10,000 investment. What would happen if we invested that and just let all the distributions reinvest for 30 years? What would it look like and what would our outcome be? So we go to deposit rules. We don't have any deposits set up. We're just looking at an initial lump sum of 10 grand. What would it be like in 30 years? Go to the forecast tab. We're on conservative model. The end of 30 years, you're looking at about $2 million, just under $2 million, producing about $9,800 a month. A very nice amount that is being reinvested. You can see your year income is about $108,000 that were being reinvested. Or if you stop that, you could start taking that as income and not touch your share count, and you would just live on that income going forward. Now, that is what's possible with that. That is with no deposits. That's that 10 grand sitting and growing, and the snowball, the dividend snowball, your yield on cost increasing because of that snowball compounding impact. Next thing we want to do is we're going to keep that $10,000. We're not going to add anything to it. up here. So everything's the same. We're still looking at the conservative. We're going to go to the deposit rules. We're going to look at $500 a month. And that's on rule number one, which we have at the 20% for each of those. You come back over here to the Forecast Pro now. We're going to look at 30 years here. You can see that your amounts, and this is where QDVO goes crazy. Look at that $12 million. And people are going to say, wait a minute, that's not realistic. And I would agree, that's not realistic. And that's why you have to consider this 10% and this 17% based on past data. It has not been through all the different market cycles. And that is what it's averaged currently from what we have going through different cycles. That average is probably going to come down. And you need to remember that. And this chart and this is all we can go by is it's going up by that percent year over year. There's no drawdowns, there's no pullbacks, and then having to recover. And this is all we get to go by is past data. As this data changes, we'll update these and do more videos to show the different outcomes, but just showing you how that impacts over different scenarios. Where Devo, you're looking at $250,000. That's much more reasonable. But even QDPL at $900,000, that's very reasonable over that time frame. And again, you can see those Devo at 5% and 5%. That's sustainable. That's something that it has shown it's been around much longer. So we have a much more accurate outlook. QDPL, that's much more realistic, of very similar, a little bit higher yield than something like SCHD, with appreciation about the same as something like SCHD. And you have that longer data. Or QDVO, that seems obviously that's not going to sustain, in my opinion. It may not. We will see. With QDVO, we only have not even 2 years of data, and it's been a very aggressive bull market that we've seen. Again, that data is not going to be as accurate, in my opinion. That's why you're seeing these bloated numbers, and something that you have to consider when forecasting, especially younger funds. People get this mindset like, oh, it's going to sustain 27% return with 17% appreciation and 10% yield. It's probably not going to do that. And when you have those pullbacks, that's when people panic and freak out because they're expecting that. I would not expect that. That is, again, my opinion. Please take that for what it's worth. But I would consider, when you're looking at these, to understand that these are bloated numbers when you're forecasting, but that's all we get to put in there. I could make up a number. I could say, well, this is what I think it would do based on other factors. But on this chart, what we do is we put in the fund, what its yield is, what its appreciation's been, and it is what it is. If you don't like using past data, then I wouldn't recommend doing that, especially with newer funds. Now, some of the older funds, you can look at that. You have SPYI. You can look at SPY. You have those you can look at and see that they have a much longer history. So the averages are much more accurate because it's the average of not just the up market or just the down market. It's the average of long term. Right now, there's lots of funds that are seeing a bloated numbers because it's in a bull market. But you can also look at the other side of that. Some of the crypto ETFs are showing a very low amount, and their averages are really pulled down because they're newer funds that have only been around since the last pullback in the crypto market. And that has caused those to seem much worse than they actually are if you look at longer time frame and averages. Please always consider that when looking at these. But when you look at that, you're looking at $128,000 of income being generated. Now, let's just do something. Let's take QDVO out of here just for this scenario. We're going to put that down to 0, and we'll put all these up to 25%. Just since that's the one that's really bloated, and throwing that off, I just want to show people a little bit more accurate. And QSIX might be a little bit bloated too, but it's not outrageous. It's a little bit high, but again, it's not 27%, a little different. Now we're looking at 25%. We're still doing the $500 a month. We have the $10,000 initial investment. Now, as we come back over here, you can see now this is with $10,000 initial investment, $500 a month going into these four funds. You can see IDVO is still, like I said, a little bit bloated. I would consider that. These others are pretty, I would consider very accurate long term, what you could expect. And so here we're looking at a little bit more reasonable, still a little bit high in my opinion over 30 years, putting 500 a month on a 10,000 initial investment. And there you can see the income being generated is about $32,000. So again, a lot of different things you can do with this portfolio planner to test things out and see how you like it. That is the five funds we're looking at. This is a much more conservative focused income portfolio. What are your thoughts on this? Leave me some comments down below. This was requested by one of our viewers. I will continue to do these requests as you submit them. Put your comments down below. We're always looking for comments and dialogue in the community. I appreciate those of you that support us that way. A lot of people ask me, how can we support your channel? Obviously, I appreciate those who buy the different spreadsheets, the financial impact that has helping us produce more videos. But the biggest thing you can do is by hitting that like and subscribe button and leaving comments, having dialogue, talking not only with me, but with each other and building that dialogue. That helps YouTube say, hey, you know what? We're going to share this video with other people. If you really want to help the channel grow and the community grow, that's the best thing you can do. And I do appreciate it. And that's it for today. We'll see you next time on Simply Money.